Startuprad.io, your podcast and YouTube blog covering the German startup scene with news, interviews, and live events.
If you're trying to understand where finance is actually heading, not what's trending on LinkedIn, not what's being pitched, but what is structurally changing underneath, this is the episode for you. 2025 was a year of contradiction. AI moved from experimentation into underwriting, fraud detection, and core operations, while regulators simultaneously tightened expectations around explainability, resilience, and risk. Banks reported stability, yet quietly restructured cost bases and exited entire value chains. Fintechs spoke about growth again, but under very different unit economics. What made this year different was not speed, it was irreversibility. Once AI is in credit decisions, it doesn't come out. Once instant payments become mandatory, latency is no longer tolerated. Once regulation moves from consultation to enforcement, business models either adapt or disappear. In this FinTech and Finance Review 2025, we stop back from the noise and ask a more fundamental question. What still matters in finance, and what quietly stops mattering next? Hello and welcome. This is Jörn from Startuprad.io, and you're listening to and watching our FinTech and Finance Review 2025. This is a tradition we kept every year since 2014. Not as a recap of products or funding rounds, but as an editorial checkpoint. A moment to pause and ask, what was fundamentally shifted? What assumptions no longer hold? And which debates will still matter 12 to 24 months from now? This year, those questions feel heavier. Interest rates are no longer a temporary condition. AI is no longer a side project, and regulation from DORA to PSD3 to MiCA is no longer theoretical. To make sense of this, we've brought together a careful curated group of voices: global banking research, board-level governments, founders operating in credit and insurance, and a global perspective on blockchain and tokenization. Each guest answered 3 focused questions: one on structural change, one on execution and risk, and one forward-looking outlook toward 2026 and beyond. What's striking is that these conclusions weren't planned. They surfaced independently across very different roles. Let's begin with the widest possible lens, the structure of banking itself. To understand where banking is structurally heading beyond products and platforms, we start with Paolo Sciaroni, who looks at finance as a system, not as a set of technologies. I would like to welcome Paolo, the most frequent guest at Startuprad.io.
Thanks for having me here every year, and happy Christmas to all of you.
Exactly. Paolo, the financial industry is being redesigned, re-architected by open finance, AI, and higher interest rates. Which parts of the banking's value chain will still matter in 10 years and which ones will vanish?
Well, I guess that high interest rates is that thing that might vanish in 10 years from now.
that was
But I guess there is a fairly secular trend about the interest rates, and everything is conjuring also for this period to be unsustainable. But it's a very, very interesting question. If I can say 2025, I see this way, was the first year when regulation went faster than the industry, because the Genius Act created a huge, if you like, discussion and set of opportunities, started from the US about the tokenization of value and money. So I guess a lot of banks got surprised and off guard on the fact that now that there is a framework, the players outside financial services can act even more swiftly and broadly, which is igniting a lot of, if you like, implementations or healthier competition. And that I think was surprising for everybody. Typically, the industry moves, although the fintech are pushing the boundaries, and then the regulators try to understand and the policymakers. But this time around, I guess it's very different. Now, still unclear to know whether the tokenized economy will be effectively unfolding the properties that many commentators are discussing, but definitely there is a strong acceleration. It's no surprise that my next research will be about banking in the tokenized economy.
Of course, there's no way around talking technology and resilience here, especially AI. I do believe that was a buzzword of the last few years. Banking is quite data intense. Is AI helping here in this data intense environment, highly regulated environment in banking, fintech, capital markets, and also maybe in insurance? Is this helping to build a safer system, or is it quietly increasing fragility?
Well, Jörn, just a few days ago, Anthropic released a very interesting yet concerning report titled Disrupting the First Reported AI Orchestrated Cyber Espionage Campaign. Essentially, what happened is that an AI framework hacked the Cloud Code model, using that model to basically understand the potential security vulnerabilities of a set of companies in financial services, in chemicals, in government, among others. I think the number was 30 firms, and then use the code in an automated fashion to basically penetrate, get IDs, passwords, and then steal data and a piece of information. And of course, Anthropic managed to detect very fast the threat, and they had to use their own AI to basically diffuse the capability of another AI that was tricking their own AI. So we have this example of an AI framework that is a set of AI agents that socially engineer an AI model, pretending to be somebody else, tricking that AI model to act in unwanted ways beyond their guardrails, helping them as an ally inside the organization to basically scout information that otherwise would have been difficult or would have taken days, weeks, or months to be generated, because the automation of AI is incredible, and the flexibility that apparently these AI agents orchestrated by these rogue traders was truly remarkable, and therefore Anthropic had to deploy their own AI to understand the trickery of an external framework onto their own AI. It's like crazy if you think about it, right? So which bears a couple of considerations. The first, since a couple of years, I've been insisting in my research that every banker must be an AI risk manager. So whatever you do, you always need to understand all of the intricacies of this new framework, because there are many and they cannot be forgotten. And then the second, is always difficult for security folks to basically do their job, because you're really never 100% secure in a sense, right? So it's like a process where you have to continuously fight to be the best. It's like you need to be the fastest racers while all the others are accelerating, getting new shoes, to run those 100 meters faster than you. They get a new diet and whatever. So that's very, very complicated, but it is feasible. And all in all, it is also about the architecture, because it probably goes down into the dungeons of how you design your hybrid cloud perspective to make sure that on top of security, you also have your secure the design at the core of everything. And so next year, I believe that as the first AI agents will be deployed by quite a number of institutions for a broader utilization, it is also the year where we have to see how cybersecurity stepped up in order to protect that framework from its own deficiencies. And if I can conclude, the issue is also the fact that we're all running towards an hyper-concentrated AI world, right? So I remember I wrote a paper for Davos 2 years ago and was discussing the problem of concentration. You have a few large companies that create models. And not only if one of those models misbehaves, that can have viral crippling effect across entire economies. But now we also have the possibility that some of them becomes too big to fail, right? So there's a lot of unwanted consequences in the last 2 years of the AI race that must be thought through. I do believe the future is for smaller models, so they will create more resiliency, but that future is yet to come while we are all building on this existing concentration where one single point of vulnerability can generate vulnerability for all. So that.
If I take something from you, just one sentence from today's FinTech review, it's every banker needs to be an AI risk manager. That's an amazing
FinTech. So every FinTech, because the history of investing in technology, not just in banking, is investing in technology that is more, and I use the word deliberately, unstable. That is a way of saying flexible and powerful, right? Because when technology is very deterministic, it can do only a set of things, right? And only those things. But AI is way more probabilistic. Generative AI is definitely probabilistic, where you have to deal with instability of the algorithm as well as the one of the human interact with the algorithm in language mode. And agentic AI is way more, right? Because you have the orchestration of multiple agents and multiple models, and the way they combine themselves one with the other is not linear. So you don't validate anymore the individual models, but a combination of the models. And that compounds the complexity to understand the potential misbehavior. So if you don't have a strong risk management understanding of how these algorithms work and where the if you like, potential threat can come from, things can be overlooked pretty fast. And in the age of AI, if you overlook something, the velocity by which can be exploited is unprecedented, right? So that's why I insist that the major cultural change that has to happen in an organization to allow AI to scale enterprise-wide is the risk management of AI at all levels of the organization to prevent, then to manage. Because it's about being capable of managing probabilistic technologies. It's like the trading floor. The fact that the models are not perfect is not the point. The point is, can you risk manage those models, right? And if you can do that, you can be successful in capital markets. And the same is with technology. If you can risk manage technology, it's no problem. You can use technology.
We're not only looking back at 2025 and the last few years, but we're also looking at 2026 and beyond. What would you say, in your personal opinion, what's the one fundamental change in global finance or fintech capital markets that almost nobody sees coming for 2026 and beyond?
Well, it's different that somebody doesn't see something because everything is so highly discussed, okay, and debated. So I don't know. I think that the banking industry is starting to reposition from the business side as well, as the geographies are somehow reshuffled. So the American banks have been gaining strength, although the Europeans got the benefit of the rise of the interest rates from the last 2 years. And the American banks, some of them had 10 years to invest into building the foundations to engage clients on the continuum of client wealth, where for the first time we see that the channel is more important than the segment. So you may neither want to capture someone across everything that can happen on the channel, because the channel becomes a platform. And many people may not have realized that, but this has been happening and going on. You can think about what companies like JP Morgan are doing, or Morgan Stanley. And I think the world is round, but we're here in Europe talking about that. We know the JPMC also tried to make inroad in the German market. So it will be interesting to see if the next year is the year where maybe through further developments of stablecoin, the capability of American banks to penetrate the European market gets intensified or not. So that is the thing that I guess people might have overlooked. So we're not just talking about technology for technology, tokenization for tokenization. The question is this giving more lever or power to some of the players that have invested in the traditional market, now refreshed with technology, to make those inroads and advances that they always dreamed of? And maybe we will see that in 2026 or 20.
So I would point out at the JP Morgan Retail Bank going to launch 2026 in Germany as one of the indicators here. Paulo, with such a pleasure having you here as guest. Thank you very much.
It is always my pleasure to be here. And for all those that are on attending, and there's many here on your podcast, I just realized that my business title is a German word, which justifies the fact that I live in Germany. Because when people ask me, Paolo, what do you do? I always say that I am the global research leader in banking and financial markets at the IBM Institute for Business Value, which in German is a single word. Christmas to all of you.
Paulo describes finance as architecture, value chains, dependencies, and concentration risks. But systems don't run themselves. Someone decides which risks are acceptable, which investments get funded, and which legacy assumptions are abandoned. Those decisions happen in boardrooms under regulatory pressure with incomplete information. That's where governance moves from theory to reality. If structure is theory, governance is reality, and Frank Schwab brings the board-level perspective on what banks can still win and where they are structurally constrained.
Welcome, thank you. It's an honor to be here year after year, so I really enjoy it.
Me too. As you got in the recording studio, I said, so we meet again this year, always shortly before Christmas. I'm very glad to have you here. Let us dive right in. Where can traditional banks still win against fintech and big tech, and where are they structurally unfit to compete?
I believe, let's say, the banks with the really big balance sheets, they still have a significant advantage over all other players, just due to the fact that they have so much assets and so many and deep customer relationships, which hold for decades. So I don't think that these bank giants have to fear competition from fintech or big tech. On the other hand, that's quite different for small and very focused banks. So if you're a small bank or a mid-sized bank, the competition you basically feel on a daily business. And if you have a limited scope in terms of product, services, and customer groups, then it's pretty important that the area which are you populating, the area you sitting in the competitive, let's say, landscape, that you are actually best in class in order to survive.
Actually, when you've been talking about this, I had in mind, on the one end, you have the very fine banks who are serving certain customer families already for decades. And on the other hand, you have somebody in the B2C space that has the longest banking history with N26. So I think there's a lot of in-betweens, right?
Yeah. And also from a business model complexity. So the business model of N26 is quite simple, right? It's a retail customer only. It's a limited set of products. Let's say if you are a traditional bank, let's say small savings banks or small union banks, which basically have the same kind of, let's say, product portfolio and focus, they can't survive. And we have seen that over the last, let's say, 4 decades. The number of savings banks and union banks, not only in Germany, the same is true for, let's say, almost any other mature country. They declined by 50%, 60%, up to 80%. So what you see, what's left over is the one who did excel in merging, acquisition, and building a significant customer base, a significant balance sheet. If you look at Spain, there are only 2 caixas, so savings banks left, right? And therefore that's what we see. Simple business model, unbelievable competition, complex business model, complex business, complex customer structures, and huge, let's say, balance sheet. That's much more difficult to attack and much more difficult to copy.
Mm-hmm. You have a broad business base, you have a broad client base, you do have economies of scale and so on and so forth. I do understand that. When you've been talking, just to tease you a tiny bit here, and I know forecasts are always difficult, especially concerning the future. Do you think that at one point in Germany we'll end up with 2 savings banks, 2 Sparkassen, and 2 union banks, meaning Volksbanken, Raiffeisenbanken, like 2 big, like 4 big players out of hundreds before?
Yeah. Probably not in my lifetime, but I that's bad. That's look. We have seen 4,000 savings bank going down to less than 400. I think we are now in the 360 or 70. So that's where we currently are. There is no reason why this should stop. There was always a discussion about Landesbanken. Why do we have more than one Landesbank? It's a fair question. And anyhow, why do you have a central bank? Because the Landesbanken somehow central banks for savings banks. They also cover a different kind of business. But let's say the question is why, right? So will we end up like that 100 years from now? Probably. On the other hand, other players, new players will have emerged and they will be established, which we never heard of before, and now part of the landscape. And also, let's say, lately, banking licenses are granted again and again and again and again for these new players. And so the landscape is changing and evolving. I believe there is still place for savings banks and union banks, but not in the form which they were successful in the past. So success in the past does not guarantee you success in the future, and that's pretty clear if you look at the structure of then the individual bank.
Sounds like an investment brochure. Past performance is no indicator of future performance. I see. Let us shift a little bit perspective. From your board perspective, are we seeing smarter governance? Are we seeing just heavier bureaucracy under DORA and Basel IV?
So there are 2 hearts. So if I look, for example, at DORA, what regulation asks for makes a lot of sense. So, for example, they ask for, let's say, assessing third-party risk and critical infrastructure providers, right? So that's actually it's sad that it needs a regulator to ask the banks to fulfill that. If you run a business, I would argue you should run it in the proper way, and in the proper way is that you in full control what you have outsourced to a third party. But unfortunately, that's not necessarily actually the case. So therefore, there is a lot of regulation. If you look at the core of it, that makes a lot of sense. And if banks don't do it by themselves, you actually need to do it, and you need to regulate it. On the other hand, I just published an article over the weekend, having last week more than 10 different board meetings and committee meetings, and my conclusion by now is there is too much, too detailed regulation, and currently it ends up and it feels like significant bureaucracy. So the challenge for the banking industry, and especially for the regulator, is how much regulation do you actually expect, and how much value does regulation create? Because as a society, we cannot afford regulation which doesn't pay out, right? So if it ends up in bureaucracy with almost zero additional value, then additional regulation does not make any sense.
I totally agree with that. Let us look a little bit into the future. We have the strategy with the board view and regulation, and now let us shift in to looking into the future just a little bit, not the 100 years we did before. What shift in banking or regulation do you think most executives will be blindsided by in 2026 and beyond?
I'm not sure whether any executive will be blindsided, because, let's say, according to my exposure, I'm not aware of any traditional bank manager who is not trying to comply to all the regulations and beef up and step up in skills and people and functions in order to make the bank full compliant. That's quite different for fintech startups and new players into the industry, and you actually can see that in the amount of fines which are especially now awarded to new players like N26, but lately also Revolut or Trade Republic. So you will see a lot of these new entrants into the banking sector who do not cope successfully with regulations and compliance. So the blindsided is more to the new to the industry than to the established industry, from all I can see.
Mm-hmm. Totally agree. Do you think there is a regulation that all regulations are known? Just assume that. I think in normal banking, that's a pretty fair assumption because they do have a lot of people working on that. With implications, how deep you need to go, how much implication in your daily business it has. Do you think there's something out there that banks don't really see right now from your experience, or do you think they have a pretty good handle on all of it?
No, it's not about that they don't see it. That I cannot experience, but what happens so first of all, most bank managers will tell you the same thing. They spend, the more senior you are, it feels like you spend 80% of your time and your money, your discretionary money on regulations. So these days, which is an unbelievable high percentage, right? And many people and many figures will support that view. How deep and let's say being surprised. Sometimes you're surprised how fast a regulation comes. That sounds strange in Europe, but for example, if you are a banking manager in Eastern Europe, then some of the parliaments they approve a law which has to come into, let's say, place within within 6 to 9 months, and that's in banking terms pretty fast if you need to comply within 9 months to a new regulation. And therefore that's sometimes where you are caught by surprise, but that's more on a very local and also non-European regulation. European regulations from EBA, ECB, and others, you're not really surprised because the discussion often is for years. At some point in time, you may be surprised by the details, which are then decided in the last minute, so that you do not have the proper time for specification. But on the other hand, I believe, from all I can see, that banks in general, banks and regulators, they work together in a way that, let's say, in a proper way, right? In a good way. So most of the time, this is not an issue, and nobody is really catched by any surprises in a significant way. Yeah, we may discuss, let's say, for example, all the ESG details, if they make sense for each and every institution, or if we need to look at let's say, proportion. So meaning, let's say, what's relevant and important for a large wholesale bank may not necessarily be useful and does not make much sense for a small retail bank, right? But still you have the same regulation, and therefore, let's say, that's something regulators identified as an issue. They also said they work on it, and we will see what then brings us in the next years. But I do not see any significant regulation which will catch up by surprise.
Frank, thank you very much. It was a pleasure again talking to you. Looking forward to have you on next year again in our FinTech review. Thank you very much.
Thank you, Jörn, and Happy New Year to all the people out there.
Thank you.
Governance may look rational from the inside, but it is judged from the outside. Media narratives, public trust, and political framing increasingly shape how much strategic freedom banks and fintechs actually have. To understand that layer, we need to look at how the story of fintech itself has changed. Because finance doesn't evolve in a vacuum, we add the media and narrative lens with Jacob Ward, who has spent years translating technology shifts into a global audience.
Thank you so much, Jörn, for having me. I really appreciate it.
My pleasure. Let us dive right in. How has global coverage of European fintechs shifted since the funding boom? Are we still telling growth stories, or is it currently a crisis narrative?
Well, I think that anyone with any sort of professional connection to the investment community has been, it's been all about the growth narrative, the sheer, the incredible enthusiasm that people in the investment community have around that world, is not to be underestimated. And so, for me once you get into the inside pages of the Wall Street Journal or any of the other, prominent outlets that cover that world, their stories are for the most part about growth. But I think as soon as you get to reporting outside of that direct business beat, then you're getting into a world in which people are highly concerned about, let's say the overlap between the crypto world and the Trump administration, and the ways in which that is a sort of unseemly connection, and the ways in which whenever someone suddenly, when there's a regulatory problem or a new rise of scams or any of that kind of stuff, I think the mainstream coverage, the coverage that is not for the business audience, but for everyone else, has been very much about the dangers of a sort of destabilized world regime when it comes to the financial markets and fintech. So I think it's very much a two-part, it's a bifurcated media landscape when it comes to that topic.
Yes, and I totally believe when you dive deeper into the specific publications, it really shifts into a very, very differentiated observations depending on the area where you're currently active in fintech. I think that the crypto guys don't have a lot of fun right now. But I also do think even people in wealth management are kind of getting worried with the valuation of the AI stocks right now.
I mean, I think that we have absolutely entered a world in which none of the old math serves a predictive purpose anymore, because we're so beyond where, your normal business school case study would tell you we should be, right? I mean, the valuations that you're seeing of these companies is so out of control. The circular financing arrangements in which these companies are they're financing each other, and they're each other's customers, and they're each other's vendors. All of that stuff, I think, is really serving to frighten the most conventional thinkers around this stuff, because there's no way to understand some of these arrangements and some of these valuations by any kind of traditional math. And I think you're in a world in which people are, seeing so much of, at least in the United States, so much of the GDP and, the S&P 500 and the rest of it depending directly or indirectly on that industry. It's one of the only growth stories around. And as a result, that also, I think, has people very nervous. And so, to my mind, there's anyone who's looking at the landscape and saying anything with confidence about where it's going, is going to get some eye rolling from the rest of the community, because there's so little of our past experiences that we can draw on in understanding where this might be going.
AI here, what blind spots does the mainstream media have when it comes to AI and financial inclusions?
Well, I think that, there's a really fundamental misunderstanding of what it is, right? I mean, we as someone who's been studying this stuff, for more than 10 years now, I wrote a book that came out in 2022 predicting the rise of commercial AI. It came out about a year before ChatGPT did. And I was trying to explain to people in that book and at that time, and I have been ever since, just how quick the human mind is to make big anthropomorphic assumptions about technology. We like to believe that it is a that it has a soul and has a personality and understands us and all of that stuff. I mean, the marketing language that we get from these companies about what these models do includes terms like reasoning and thinking and the rest of it. And in the mainstream media, we have been so quick to just adopt that language when any real clear-eyed assessment of what these systems are should be trying to remind people again and again, these are just big statistical vacuum cleaners that regurgitate the math. They're not reasoning models. They're not thinking anything, And so from that place alone, we've been in an enormous blind spot. Excuse me. And then I think beyond that, there's a real, one of the hardest things about the news business in my world is, it is by its nature a backwards looking medium. It reports on what has already happened. And as a result, it doesn't, mainstream coverage doesn't like to predict what might happen next or report on what might happen next. And so that's been a real challenge in my career as someone who thinks almost exclusively about what's going to happen next. And so, other blind spots include things like, it is coming to light that there is enormous, bias cooked into these systems that is clearly, as case law moves through the courts, going to be unveiled. I was literally just speaking to a researcher who's one of the top researchers on bias in the world, and she just she's showed in paper after paper since 2023 that these systems are sometimes 2 or 3 times as biased as humans on average. And when that hits civil rights law or Federal Trade Commission law around biased lending or any of these other sort of laws that are intended to try and keep us pluralistic and neutral in this country, I just think there's huge blind spots in thinking about the implications there. So I think that from really just not even understanding the zeros and ones of how these systems work, all the way through to not thinking, I think, in the right time frame about their effects on society in the coming couple of years. We're so focused on job loss. We're so focused on the Terminator scenario. I think we miss the chance to investigate some other really important things that are about to be affected by this stuff.
When you talk about Terminator, what also comes to mind is Hell, Space Odyssey, and so on and so forth. So I really think the narrative is somehow driven by what has been written in the past, because if you do have a bad, mean AI, it makes a much better story, right?
Yes, I think that's absolutely true. And it's really interesting to look at the contrast between a place like the United States, which has a long history of science fiction around, the Terminator and, evil robots. We love to tell those stories. Whereas a country like Japan has a long history of, characters like Astro Boy, who is a friendly nuclear powered robot that saves the world over and over again. There's a long cultural history of positive portrayals of technology in other countries. And so it's absolutely right. I think that our zeitgeist has very much been about, a fear of robots in the United States. And so, yes, I think that's absolutely the case. But I also think that's, as a result, serving to distract us from some of the more near-term abstract difficulties we're going to see with these systems, the de-skilling of people and the wiping out of categories of jobs that turn out to really give young people a sense of purpose. And there's going to be all kinds of effects that we just aren't really prepared to talk about, because it's not as easy to write a summary of that as it is to say, it sounds like the Terminator, but it's real, blah, 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 blah. There's a real there's a tendency to rely on the science fiction tropes just because, everyone's overworked and moving fast, and it's an easier thing to write than something bigger and more abstract around human psychology or human society.
I was wondering, what storyline or paradigm shift do you think will define fintech coverage 2026 and beyond?
Well, my feeling about the technology space in general with AI, I think one of the things that's, there's a more kind of dollars and cents one and a more social and sociological one. And so the dollars and cents one, I think, is going to be depreciation. I think it's going to be the physical infrastructure on which all of these AI companies are going to be built, they're all on these depreciation calendars of like 5 years or more, where in fact this hardware is all going to have to be replaced in 2 or 3 years. You've got the enormous physical cost of building the infrastructure that's going to make all this stuff possible, I think is something that is going to absolutely define the next couple of years. And we are just beginning to deal with what that's actually going to mean. On the sociological side, one thing that I just spend a huge amount of time thinking about myself is this broad umbrella topic that I call AI distortion. And it's the way in which our thinking is distorted in the presence of this technology, whether it's the investment decisions we make, whether it's our personal interactions with this technology, whether it's the ways in which we come to believe that we, in the United States, we come to believe that we somehow shouldn't regulate it because that's going to slow down our fight against China or whatever else the excuse is. There's a real distorted kind of thinking that I think we're going to see play out in story after story, whether it's kids using these systems as a best friend rather than befriending real humans, or a big bank coming to believe that that their whole business line can be placed on the shoulders of AI. I think there's a kind of distorted thinking that is going to make itself manifest over and over again in the coming year. And so that's my prediction is unpacking AI distortion will be certainly my job and the job of a lot of journalists coming up.
Yeah, what has been popping up in the back of my mind when you're talking about misconceptions about AI was the $1 billion revenue company with just one human employee. Yeah,
that is such a big one, right? So yeah, for anyone who doesn't know, right, Sam Altman a year ago on Alexis Ohanian's show talked about how he and his tech CEO friends have a bet going as to when we will see the first $1 billion one-person company. And that right there just tells you everything you need to know about what we're going to see in terms of, what a company like that would define as a success, which is $1 billion one-person company, versus what a politician in the United States or a labor leader in the United States or a city mayor in the United States would consider a success. Those visions are so far apart, until we can bring people's feelings about that stuff into better alignment, I think that there's an incredible amount of distorted thinking around what success with AI is going to look like, and we'll have to unpack a lot of that.
Jacob, it was such a pleasure having you here. Hope to have you in spring for another interview, talking a little bit more about you and your book.
I hope so as well, Jörn. Thank you so much for having me, and Merry Christmas and Happy New Year. I hope you have a great holiday, and see you on the other side.
Thank you very much. Same to you.
At this point in a conversation, one theme becomes unavoidable. Most of the changes discussed here are no longer reversible. AI is no longer optional, regulation is no longer hypothetical, and trust and capital discipline are converging. What differs is not whether change is happening, but where the breaking points will be. And nowhere do these tensions become more visible than in credit. When structural change reaches capital allocation, it shows up first in credit, and that's exactly where Luca Finani operates.
Hey, Jörn.
Hey, Gude.
Gude.
Yeah, you are joining us directly here from Frankfurt, so we could have also almost made it an in-person meeting. We're talking a little bit about you in the fintech landscape, about lending and private credit in transition. I think I don't need like a big introduction for you because you are a regular guest, I think, for 3 years now.
I think it could be 3 years. Yeah. Is it really that long?
Yeah. Yeah, it's already that long. That's one of the moments you realize you're getting old. Oh, it's already 3 years, huh?
Yeah. Let's not talk about the years.
Yeah, it's not the years, it's the mileage. Let us dive right in. As private credit grows, are we repeating the old shadow banking risk under just simple new tech wrappers?
Ooh, that's a tough one to start, but also a very good one. And I would like to say, to your point, it may seem like it a bit, especially with what we've seen sometimes in the US with stuff that's happened with Tricolor holdings and First Brands, and some of the jitters that we've seen in the market. I would nevertheless say we're not seeing a repeat, but what private credit is undergoing at the moment is more a transformation. And transformation in the sense that refinancing processes and lending processes, they're being reshaped and digitized as we go along, because we now have a lot of new technology, especially also with the advent of AI. We have more efficient ways to kind of check and sanity check specific things. So really, technology brings in transparency and also real-time monitoring capabilities to lenders, to institutional funders. And those are simply tools that, when we think back to the financial crises of old, that simply weren't there. So basically, old legacy shadow banking just lacked these things. So I do firmly believe that we're not seeing a repeat, but more transformation that's going on in the market, just because we have a lot more ability to also sanity check, triangulate certain data, and verify some data. And so if that's done properly, then there are a lot of people, a lot of projects that are working towards the goal not to repeat sort of old shadow banking risks.
Mhm. I was wondering, what's the real advantage of algorithmic underwriting today? Is it just speed? You get there faster? Is it scale? Or can you really price the risk in a smarter way?
I think we need to differentiate a bit, and I think those three elements that you are mentioning are really key ones. I think it's a mix of all of these, but I also think we're not really there yet, that we're in a fully algorithmic underwriting sort of environment. I think when you are looking at granular lending, let's say buy now, pay later, SME lending, consumer finance, um, essentially processes that really have to be automated, then we're pretty much close to algorithmic or at least automated underwriting, where definitely speed and scale are sort of commodities, and that's really an advantage. But it's also, from a borrower's perspective, more or less expected. And I think then, with other pockets in the market, it doesn't really make any sense, especially like to let's say, more private debt areas like leveraged loans, or even traditional mid-market lending. It's just too bespoke, so there's generally not a lot of data that's available on the basis of which a machine learning or AI model could sort of be trained. So the benefits to algorithmic sort of underwriting would be marginal, if any. So I think this is where we need to really differentiate. But overall, it's speed and scale, obviously, of doing a lot of lending transactions. That's sort of the benefits. And the real differentiator is, of course, smarter risk pricing as well. So ideally, you would want to see that your ability to price risk, either in predicting defaults or, price risk on a risk-adjusted basis, and basically lower sort of your cost of funding. Those will be the real benefits to lenders. Yes.
Mm-hmm. I was wondering, what credit market development isn't being priced in yet for 2026 and beyond? Is it something like a
Ooh. So now, yes, bad word, and now we're talking about we're looking into the crystal ball that both of us don't have. No, I think it's I think one of the main themes that probably isn't really priced in yet is one of the tokenization of private credit. I do think that there is a big case at the moment going on for sort of democratizing access to private market on private equity and private credit. And a lot of the focus this year has been sort of in fund structures like LTIFs and so on. But I do think that tokenization of private credit just brings in another dimension. So that has the potential to, in my opinion, really reshape also secondary market trading. Then obviously the benefits of AI-driven sort of underwriting and portfolio optimization. I think we're only at the beginning of this whole trend. So I think that is also not fully priced in yet, which would be sort of the good scenarios. Especially focusing on Europe, I do think there is a certain element of regulatory tightening, especially with the implementation of DORA and then the EU AI Act, which is sort of looming on the horizon, which is basically just some parts of the regulation on IT security, operational resilience, and so on, that will force also lenders to probably also invest a bit more heavily in being compliant in order to be able to carry on. And I do think that there is still a certain underestimation, at least among some parts of the market, in terms of what this means related to cost of operating, as well as to organizational requirements in order to be able to fulfill those regulatory requirements or be compliant with the regulatory tightening. And I think another element which is interesting is going to be kind of a reality check, because a lot of lenders have, especially in the fintech space, sort of started in 2016, 2017. So we haven't really been through a full credit cycle yet. I mean, in some economies, especially Germany, we've seen a rise in insolvencies. So it's also going to be really interesting whether the credit collection processes actually hold up what they expected, and whether some money from loans that were restructured or defaulted can actually be retrieved. And so I think that's going to be also pretty interesting to see how that part of the lending equation really holds up, because it's in good times that's also pretty equally or pretty easily overlooked. So I think those would be the four elements that are not yet fully sort of priced in 2026, I think.
I would be interested, because if you're referring to a downturn of complete credit cycle, you have expansion, you have the downturn, you repair, and then you recover. You're implying a little bit that we are in the downturn. Some started in 18, 19, so that means the expansion phase has been, rough estimate, 7.5, 8 years, something like that. When do you see the downturn ending?
I'm not saying, look, I'm not saying, we're in a downturn, or things are tough. I'm just seeing, there are structural changes, and I think with economies in different places across the globe are in different spots. So there's just going to be some macroeconomic divergence. We have central banks that are in potentially different cycles of the rate setting stage. We've seen the Fed, for instance, on a path towards a bit more easy or loose monetary policy, whereas on the ECB, we've probably reached sort of the end of the rate cutting cycle. And so there is just a lot of macroeconomic divergence and uncertainty, and that just means that obviously in some parts of the credit markets you will definitely see some of the effects. And I mean, in Germany, for instance, and in Austria, we've just seen a certain uptick in insolvencies. just across the board, nothing specific to fintech lending. And so that's why I'm saying, it's in a way, it's a good thing because it's also a reality check and kind of we're going to see how some players have been holding up and which underwriting processes have worked and haven't, and also whether the recovery and sort of recovery expectations on defaulted loans are actually going to be what we all assume them to be. But so far I don't see any sort of significant risk of like further downturn. It's just part of the continuation sort of this trend.
Yeah, what the trumpeter said, there's always a cold shower involved from time to time. I was trying to get a lawyer to talk with us here. Unfortunately, I could not get one because I would be very interested in how the authorities approached the first full year of DORA and how hard they actually audit the respective startups, because that's either going to be just fine or it could be a very rough spot for many startups. But unfortunately, we don't know it yet. But let's talk about it next year in the next FinTech review. How would you like that?
I'd love to be back, of course, and I think I'm also very curious how that pans out.
Awesome. Luca, it was such a pleasure having you here. Merry Christmas, Happy New Year.
Thanks, and to you too. Cheers. It was nice to be here.
Credit exposes institutional risk, but consumer finance and insurance exposes something else entirely: trust at scale. Automation only works if customers believe outcomes are fair, especially when something goes wrong. If efficiency is fintech's promise, trust is its limiting factor, especially in insurance, which makes Meri Savolainen perspectives especially essential here.
Hey Jörn, great to be back. I'm Meri, I'm CEO, founder of Insmo. Insmo is one of the fastest growing embedded insurtech startups on the European insurance market. And we are here to generate amazing insurance experiences for the consumers, for the partners, and really provide excellent insurance services hidden into other products and services.
Let's dive directly into the topics we'll be covering: insurtech and customer trust in digital finance. We're talking about digital insurance rebuild speed. How do you rebuild trust in the age of instant claims and algorithmic decisions? Because I'm very, very sure a lot of insurance customers will have over the next years the same experience as people. You remember those phone lines, those call centers, those automated calls that never understood what you want to have. I'm sure they'll have the same experience with AI agents. What do you do here?
Mm-hmm. So we are always very curious about how we can enhance the customer experience, because this is based on the customer experience. We are also tailoring our products and services. And it's very interesting that we have investigated the AI services topic a lot, and we have tried to implement also AI into our chatbots and consumer experiences. And it's pretty interesting discovery that we just made, I think last year, where we understood that the insurance customer wants your experience to be so intuitive that they don't have to open the chatbot, that they don't have to write you an email or pick up the phone. So we see that the younger demographics and the millennials want to be able to manage everything by themselves without ever contacting the insurance carrier or the provider. So this is also one of the reasons why we haven't maybe put more investments into the chat developments, because we just saw that the customer needs are lying somewhere else and they just want to have a perfect self-service. And I think this is sort of the whole dynamics of the customer requirement in the insurance space, is that people want to do things themselves. They don't want to be bothered by phone calls, emails, chats, and whatsoever. So this means that we have to put more emphasis on the overall experience of how the customer can self-serve them the best.
I think that's profound insight, because many people are here talking about, we do AI, we do chatbot, we do agents for our customer service. But what you figured out is, hey, most people don't need it. You have to do it as intuitive as possible, and people just don't need it. I think that's pretty interesting. And hopefully a lot of people are listening out there to what you have to share with us here. I was also wondering, you were talking about embedded insurance. Can this ever become a sustainable core business, or will it remain a cross-sell feature?
I think it can be a pretty sustainable core business. And well, for Insmo, it is the core business. And what we see out in the market is that in Europe, there is 100 billion uninsured gap, because 70% of the people do not want to buy insurance because it's so cumbersome. The policies are long, the claims are so draining for people. And we always have this nagging feeling that whether I ever get paid, if I actually need this. So there's a massive underinsured gap. And then the second angle, there are retailers, banks, manufacturers who are leaving billions on the table when not embedding insurance into their products and services, because this is where the customer expect to be served with coverage at the point of sale, when I'm buying my next ticket, when I'm paying for something else. So we do see that this is the new way of customers shopping for insurance, because naturally, especially when we talk about the younger demographics, these people do not want to go shopping for insurance because it's nothing sexy. Nobody wakes up 3 a.m. in the morning looking for another insurance product. So it means that the needs of the customer are very different, and they expect the insurance coverage to be there when I'm buying something else that is important or relevant to me. So we do see that the embedded insurance market is booming and growing globally. And more retailers and manufacturers are looking for opportunities to integrate these offerings to their other products and services, and not only to increase their customer satisfaction, but actually to increase their margins per customer quite significantly. So yeah, I do really think that for a lot of insurance companies, it could be actually a core business in the future, and this embedded insurance strategy.
And as we just learned, if you don't do it, you may leave billions on the table aggregated. Interesting insight. Let's talk a little bit about 2026, which at the time of publication is just 2 weeks away. Which behavioral or technical change in consumer insurance will surprise everyone in this year?
So
I don't worry about it. I know forecasts are always difficult, especially concerning the future. I know that.
Mm-hmm. So in insurance, I think we will definitely see the AI adoption quite a lot, and especially when it comes to insurance underwriting and pricing, right? And customer consulting. I do think that there will be definitely several players out there who would like to implement AI into their customer service. Either it's like robo chats, AI chats on their website, and so on and so forth. And I do believe that in very easy and very not very complex cases, these could be helpful and advancing to some extent the customer experience and customer communication. But what we have seen is that often when the customer reaches out to an insurance company, these cases seem to be more complex. And in this case, the customers expect to be served by a human or in a more helpful way. So in that sense, I think we will be seeing that insurance processes, claims handling support will get much faster than it was like in the previous years, and all thanks to implementing LLMs and AI into the processes. And we do believe that the customers will win from much faster resolution times than ever before, and it will end up customers being more happy, getting paid faster, and not in weeks or months.
I'm just trying to wrap my head around this, remembering the time when you had to write something via snail mail with a typewriter to make an insurance claim. Yeah, insurance has come a long way. Mary, thank you very much. It was a pleasure having you as guest. You want to say everybody goodbye and Merry Christmas?
Yes. Wishing everybody a joyful holiday season and getting ready for the amazing new year with new opportunities ahead.
Great. Thank you very much.
Thank you, Jörn.
When trust becomes institutionalized, it turns into infrastructure. And infrastructure raises new questions. Who owns it? Who governs it? And who settles risk when something goes wrong? To close this review, we zoom out beyond Europe. To look at tokenization and digital ownership from a global angle, we welcome Michelle Singh from Silicon Valley.
Hi, thank you, Joe.
I remember a lot from you, and people who are listening to our internet radio station may recognize your voice. You're hosting the Stanford University campus radio show called Laptop Radio, right?
Yes, I'm a host from Laptop Radio. I've been talking about crypto for a long, long time.
And before that, you had a payment history. You worked as first Asian American at PayPal.
Yes, I was an attorney at PayPal for 6 years, from 06 to 12. And I basically handled payment transactions and supported Bill Me Later and Zong, as well as the core PayPal transactions.
Mm-hmm. And I also remember you are a mentor of the Berkeley Blockchain Accelerator. Is that still true?
Correct. I've been a mentor and advisor to a number of different companies, but I've also supported the Berkeley Blockchain Accelerator from the beginning. Also, I'm a mentor at Techstars Web3 Launch Pool, Outliers Fund in London, and a few other accelerators in the Bay Area and also globally.
Few other accelerators. Okay, I see. Let us dive right in. I was wondering, how do you see blockchain's trajectory shifting as tokenization becomes more regulated from Silicon Valley to Europe?
Yeah, I'm actually really excited about tokenization. So in about 2021, I remember speaking with a payments accelerator, a pretty big one. And I remember telling him that, like, as DAOs become normal, there will be more tokenization. And I'm talking about tokenization of stocks and normal companies. So I'm referring to the board as a DAO and, having digital stock. So I think we're moving toward that direction.
Interesting perspective. Tokenization. And where do you see this going long term? Sorry for the interruption.
We're still at the beginning of the tokenization movement. I think the current stocks could be tokenized, but we're going to move beyond that to real estate, art, and other real world assets. And in about 5 to 10 years, I can see boardrooms being tokenized and voting on chain. So, in normal companies, there are, I used to help manage the board. So there's a lot of issues with fraud. Everyone knows about Sarbanes-Oxley, but I feel like when voting and everything is going to be on chain, it's just really easier to manage. So the private shares could be on chain, and they could be distributed, and people with the digitalized asset or the tokens could vote. And I'm really, really excited about that, right? I also wanted to point out that I feel like there will be more liquidity in the security token sector. One of the biggest issue with builders in the last couple of years is that even if people want to create security tokens, there's no platform or there's no liquidity. So, but I feel like that because of tokenization, going a little bit more mainstream now, there will be more liquidity as well.
Actually do feel, yes, there will be shares tokenized, but as a former capital markets management consultant, I also do feel in the fixed income space, like all the different issues, all the different interest rates, all the different maturities of fixed income, of bonds, asset-backed securities and stuff like this. I also do feel there's a big opportunity for tokenization there as well.
Yeah, so I know I have a contact who have worked on a bond for a city a couple years ago as well. So I expect to see those more normalized now that tokenization is a buzzword, in the blockchain world.
I don't think anybody out there who has not been in tokenization or capital markets realizes how many different bonds, fixed income bonds, are actually out there. A city can issue for certain projects, for the overall project, different maturity, different interest rates. So any given city can have like 50 to 100 bond issues outstanding. And when you just multiply this by the number of cities out there, you see how much of administrative stuff there is, and I do believe tokenization can make a real dent there in the administrative duties. We already talked about globally here. I was wondering if global crypto regulation is slowly aging, or are we heading towards a permanent East-West policy split here?
Yeah, I think that having worked with different governments, you know, I used to work with one of the government in Canada, and being in the US, I think a lot of the governments might not follow the US or the SEC in blockchain regulation. And I didn't think that it was a necessarily bad thing because, like each government has their working group to do research, and what they find and their, might be different, and their needs might be different for that country. But I think because there's different regulation and the people are smarter about blockchain now, like they understand DeFi and NFTs, and more of the normal crypto stuff, that they could review each other's regulation and kind of take what works, right? Because I feel like even with the privacy regulations in Europe, like from California, for example, I saw that, the California is establishing a privacy, office, if you will, right? So, and I feel like a lot of their regulations echo the regulations in Europe. So I believe that we will see a lot of that, but I also expect to have differences between the different countries as well.
We're talking about 2025 here, but I'm also curious about your outlook. What blockchain or fintech transformation almost nobody sees coming for 2026 and beyond?
Yeah, I think there will be a lot more AI agents that could accept payments. I've built agents here and integrated Web3 payments, and it's really, really easy. I think, for agents and payments in Web2, it takes a village to allow for that. But I feel like blockchain enables coins and tokens in USDT a lot easier. We also have stablecoins. I think people understand, that stablecoins are more or less volatile, right? Because they're pegged to something, so the world basically recognizes it now, which is awesome. So I'm expecting to see more innovation in stablecoins. One of the issue in a stablecoin that people haven't spoken about, and I used to work at an algo-based stablecoin company, is if you create a stablecoin in more of the traditional sense, you don't really know whether it's peg or not, right? Because it could be hidden somewhere. There's no transparency. However, if it's an algo-based stablecoin, you don't know whether it would rebase. Traditionally, some of the more algo-based Bitcoin has dropped to zero, right? So I think it's an opportunity to not just look up a stablecoin, but look at the nuances and more of the issues impacting stablecoins more deeply. And that goes the same with AI agents, right? So we're looking at identity for AI agents. We're looking at how they're making payments, like registry, and then also we call it KYA, know your agent. And also how they would take payments. So I think those are going to be more, I just went to a AI conference yesterday where some of those issues were addressed, but I'm also involved in decentralized AI. So in Web2 worlds, only a few companies basically own all our data, and they create the data mine, right? So our data is used, to create LLMs and reasoning. But how do we create a decentralized AI system where the world and 8 billion people can participate? And the good news is that people are starting to think about that. So I'm really bullish on more of like a decentralization of AI. And then also, more transparent stablecoin and tokenization that move beyond, beyond stock into real world asset. And then also, I think the other thing I want to mention is that more developers coming into Web3, because it's still a very niche market. A lot of people trade, but it doesn't mean that a lot of people build. So I'm expecting to see a lot more people coming to Web3 because, we have a lot of open sourced tools. And I think just more from the principle of creating a decentralized ecosystem where there's more of a shared ownership.
You've been talking about decentralized AI split between more players. We've been seeing a handful of players dominating global LLMs. Do you think that'll change over time?
Yeah, I think so. I mean, it's really hard, right? In the Web2 space, there is almost a monopoly. There's like 4 or 5 players that dominate that space, and they have a lot of money, they have a lot of data, and Google is kind of leading, slowly, and I'm not surprised. I'm not surprised because when I was learning about AI, that's like 2012. Google has been making AI at that time. I used to go to their conferences. So I'm actually not surprised that Google is catching up. They were really being really careful because of the security aspect of AI. So I expect to see, I think over time, if there's certain things that are going to go on, there might be more class action and more regulation as a result of that. But I think it's a little bit kind of scary just because, when you really think about the last generation where Facebook, Apple, and a few other companies, basically own tech per se, right? Now we're having more consolidated companies owning our information. You can see that all the podcasts are mine now. because they're going to use it to train data and to train reasoning, right? So it's becoming more dangerous, I believe, and more segmented. So I think, and that's why decentralized AI is going to come in. Because I think if we stop using centralized AI and then kind of start using open source LLMs or using more decentralized systems of LLMs, I think it's a little bit better because things are a little bit more spread out. And, there will be more ownership as well.
Mm-hmm. Mm-hmm. Interesting perspective. Let's catch up next year and see if this came true already. Michelle, it was a pleasure having you as guest. Thank you very much. Happy holidays.
Thank you. Happy holidays.
If there's a clear takeaway from this year's FinTech and Finance Review, it is this. The next phase of financial innovation will not be defined by speed. It will be defined by resilience under stress, governance under scrutiny, trust under automation, and capital discipline under higher rates. AI will not remove judgment, but it will expose weak processes. Tokenization will not remove risk, but it will change who controls infrastructure. Embedded finance will not work everywhere, but where it does, it will quietly reshape margins and power structures. As we look toward 2026, one distinction becomes decisive. Tools are easy to copy. Systems are not. The institutions that win will be those that understand structure, not just software, and resist the temptation to confuse tooling with strategy. Those who mistake implementation for understanding will struggle, even if they adopt the latest technology first. To all our guests, thank you for clarity, your honesty, and your willingness to look beyond the hype. And to our listeners, thank you for making this annual review one of our most listened to episodes year after year. This was the FinTech and Finance Review 2025. I'm Joe from Startuprad.io. Have a thoughtful end of the year, and we'll see you on the other side.
Hello, my name is Paolo Seroni. I want to wish you all a Merry Christmas, Buon Natale e Buon Anno Nuovo. I'm here on Startup Radio. Attend all of the episodes during the vacation. Enjoy.
Hello, everybody. I wish all of you a Merry Christmas and a Happy New Year.
I'm Jacob Ward, speaking to you from the Bay Area in California. Happy holidays, and may we all understand better what AI is and what it is not in 2026. Take care.
Hey guys, this is Luca from Exelon. I wish you all a very Merry Christmas and a Happy New Year.
Hi, I'm Mary, CEO of Insmo. I wish everybody a prosperous new year and happy holidays.
Hey, it's Michelle. You're listening to Startup Radio. It's 2026. I wish everyone a Merry Christmas and Happy Holidays.
That's all, folks. Find more news, streams, events, and interviews at www.startuprad.io. Remember, sharing is caring.